Rick Lake, a lot of people want to be in long-only funds, especially after a banner year like 2013 has been. So how much of their portfolios should they put in a fund of fund like your LASSO fund?
Well, that's an interesting question. The challenge with long only is it sometimes can be wrong only. And typically equity risk rises after a run up. So now is a good time to think about diversifying your portfolio and considering alternative strategies as a complement to equity exposure.
How do you choose the long-short funds within your LASSO alternatives fund? Because it has not been an easy year for the shorts.
It hasn't been an easy year for the shorts. The way we choose our funds is we look for managers who are battle-tested veterans. And in the world of short selling, you need a battle-tested veteran to do it effectively. Our managers, in terms of their use of shorts, are either trying to hedge market risk or they run very diversified short books because they know any given stock might move against them. And with a diversified short book, you can reduce some of the risk of individual shorts moving against you, and you can spread out that risk management technique for possible market decline.
So you don't want to get caught in something like a Tesla or a Netflix. You need to be wary of those type of investments, which just can run away even if the fundamentals may or not be there, right?
Exactly. A short seller needs to be wary of the momentum shorts. But the interesting thing short sellers are telling us now is that for the first time since the peak of the tech boom, there are stocks selling at 10, 12 times sales, not earnings. And we all know what happened right after that. Investors finally realized some of these emperors weren't wearing any clothes. The stocks went down. The short sellers made a lot of money.
So the opportunity is there for a lot of short sellers, perhaps in 2014. What about in merger arbitrage? Because that's another component of your LASSO alternatives fund. You expect a lot of deals in 2014?
We're expecting an increase in deals. Now, the purpose of merger arb in our alternatives portfolio is it tends to produce smooth returns independent of, or somewhat independent of market direction, because merger arb is about collecting deal spreads. And one interesting thing about a merger arb these days is since the deals come fairly frequently, the spread size adjusts based on interest rates. So if interest rates rise, it can be an interesting complement to floating rate type strategies. And as certainty picks up around growth in the world, corporate executives are more willing to put money to work. We see a steady increase in deals. So these managers will have more to do.
All right, good for them, good for you. Thanks a lot, Rick.
A pleasure, thank you.
And thank you for watching The Street.